Chinese banks are failing. The Evergrande crisis that started in China, which led to a developer crisis with a lot of property developers going bust, leading to a property market downturn in China, has now led to many banks in China starting to fail, and it's also led to a huge amount of protests, social unrest in China as people protest and stop paying their mortgages, and people are running to the banks because they no longer trust the banks and they're withdrawing all their money. But this is only just the beginning, and this could be the beginning of a much bigger crisis than the global financial crisis in 2008. And I'm also going to go over in this video the stock market rally that has recently happened and how many people are about to be fooled, because this is a simple stock market rally and the stock market is going to go much lower once all these crises, which I'm about to go over in this video, come to a head. And I'm also sure many of you have been wondering where I've been for the past couple of months, which I'll get into later in the video. But first, we have so much to cover what has happened over the past couple of months, because I wanted to wait for these crises to happen, which I've been warning about, which I've been trying to tell people are going to come. I wanted to wait for them to actually show themselves, and now we can go over deeper into why they happened, and is it going to get even worse than what's happening now. Well, everyone, let's not waste any time. Let's get straight into the news, the facts, and the data. Okay, first things first, let's talk about what is happening with China right now, because I'm sure many of you seen the videos of the bank runs in China, the social unrest in China, people protesting how banks are going bust, they're losing all their money, people are boycotting the banks by refusing to pay their mortgages, and it's looking like the great economic miracle that was China, this economic boom that has been happening in China, has come to an end. Now, I actually started covering what was happening in China in late 2021. That's when we found out that the most indebted company in the world was Evergrande, and they were going to default on $300 billion worth of liabilities. Now, many people said, don't worry, China will bail him out. There's nothing really systemically wrong with China's real estate market. There's nothing systemically wrong with the banks. There's nothing to fear here. And I said, look, there's probably going to be a media blackout in China with what's going on with Evergrande. And also what happened with China is a lot of the time they would try to get my videos demonetized. I'd do a video, other YouTubers would do a video, try to tell the people what's really happening. And then they'll send bots to get the videos demonetized and try to stop these videos being promoted in the algorithm. And that's how China is not only centering content in China, but how they're also centering content in the West as well. But that didn't stop me. I kept putting out content to show what is really happening in China and how reliant China is on the real estate sector. Now, for those that don't know, China makes up to 30% of their GDP, and up to 70% of people's wealth is invested in real estate. Because unlike the US, not everybody invests in stocks, not everybody invests in gold, not many people trust putting all their life savings in the banks. So over the past few decades, the real surefire way to create wealth in China has been real estate. But what this has also created is simply a Ponzi scheme. And to put it very simply, how this Ponzi scheme works is, there will be a developer, he will go and buy this land off the local government. This is also a way local governments have made huge amounts of revenue by leasing this land to developers. Remember, people don't own land in China, they just lease it, and probably a couple of decades later, they'll just demolish the development to build another one. But what they would do is people would go and buy these developments or these apartments, what we call off the plan, years before they're even built. And then the developers would take that money, and instead of saving it for the development, they would use that money to go and buy more and more projects. And like any Ponzi scheme, it works when there's more and more buyers coming in. But once the buyers stop coming, that's when the Ponzi scheme becomes unraveled. Now, some of you may think, okay, this is a few developers going bust, no big deal for me in the US, in Australia, Canada, etc. But no, people, this is going to affect us everywhere around the world because China has been a huge contributor to global growth and global GDP. Just look at this chart here of direct investment of the United States in China from 2000 to 2001. And we can see here in 2000 it was only around 10 billion. But we can see here now in 2021, it is now over $100 billion every year that's being invested in China. Now, not only this, these developers have not only done developments in China, some of them have started to do developments in many major capital cities around the world. And if their developments go bust in China, they're going to have to liquidate other global assets and other global real estate around the world to cover these losses. And like I said, Evergrande was this first domino to fall. Then we saw many other developers start to go bust in China. And like I said, this exposed the Ponzi scheme in China and people stopped buying these developments off the plan. And this caused property sales in China to plunge over 30%. Now, what you're probably wanting to know is, okay, how could this actually be worse than the 2008 subprime mortgage crisis in the US? Now, like there was a lot of dodgy lending in 2008 by the subprime mortgage crisis in the US, there's also been a lot of dodgy lending in China because people were desperate to buy a home. People were putting generations of money together just to buy some of these apartments because, again, it was really the only way for people to make wealth in China. Now, what you have to know is in 2008, the housing market was valued around $30 trillion in the US. But guess how much the whole real estate sector is valued in China? That's right, it's valued at over $60 trillion, more than double what the housing market was valued in 2008. Not to mention all the bank's assets that have loans against all this real estate in China, and also foreign investors that will have money invested in these banks in China as well. Now, since 2008, I'm sure you know the world has come much more globalized and it's become much more interconnected, especially the global financial markets. And that's why we have to pay attention to what's happening in China, because what's happening in China will affect us. Listen to this. Look at this. China's offshore defaults rise to record levels. And yes, there is a small drop in local delinquencies, but that's because things are being covered up. Missed payments have set yearly record high off offshore notes, and firms have used extensions to help avoid onshore delinquencies. We can see via this chart here, most China corporate defaults this year have been on offshore defaults in 2022. So you're starting to get the picture on how this is affecting us, everyone in the West. And what's also making things worse for China is China's still going over this COVID zero policy where they keep on going on these crazy, long, harsh lockdowns for prolonged periods of time, even now in 2022. And this is continuing to affect the supply chains and making the supply issues worse, but it's also destroying retail sales. Consumer confidence is falling in China, and it's also going to affect exports in China, which means if they're not making the goods, we aren't going to be there to buy them. And if things couldn't get any worse, there's also more and more tensions being built up between China and Taiwan and the US, especially with the recent visit of Nancy Pelosi. This has completely outraged China, and we're not completely sure yet on what China's response will be to this visit. This is adding to a lot more uncertainty. So just alone, the crisis going along in China is reason for concern. But we have many, many crises happening at once. We have the European energy crisis that's going on right now. We're seeing gas bills in the UK rise to about £5,000 per year. And they're refusing to admit it, but the US is now officially in a recession. Like I've been warning about, people. I've been warning about at the start of the year, we are already in a recession. We just don't have the data yet. And many of you agreed that this already does feel like a recession. But now things have gone completely crazy. The US government is now trying to change the literal definition of recession. Before, we all agreed that the literal definition of a recession was 2 negative quarters of GDP. Now they're trying to say, no, that doesn't, mean that. Look at the employment, it is strong, everything's strong with the labor market, businesses are strong, people are spending, credit card spending is up, there's no recession. Well, people, we all know, yes, we are in a recession, and they're simply trying to manipulate the data to make it look like a more rosy picture. We can see here in Q1 of 2022, GDP fell by 1.6%, and then it fell again in Q2 of 0.9%. So debate is not whether we're in a recession now or not, but are we going to be facing a depression? And many other people predicted this recession. I did a video on Elon Musk predicting that we're going to enter recession mid this year. I did that video at the start of the year. So also props to Elon Musk. He got this right as well. Not only this, but we had the inverted yield curve, the difference between the 2 and the 10-year yield on the US Treasury bond. And every single recession that has happened over the past few decades has had an inverted yield curve before it. But what do they keep saying why we're not in a recession? They're saying, well, look at the unemployment rate. Is it so low? Again, people, this data is manipulated. The way they record unemployment is they only ask the people that are actively looking for a job. But if you actually have a look at this, the participation rate, let's see what this story is telling us. Look at this. This is the Labour participation rate. And we can see here in 2000, it hit a high of 67%. But what has been happening since then? The participation rate has been collapsing, and now we're at only 62% of people in the US are employed. And this makes the unemployment picture look much, much better. Also, for example, if someone's working an hour a week, they are employed, they are not unemployed. When we have a lot of people, they're also picking up second jobs just to try to keep up with the rising cost of living. Now, also something very significant that is going on is inflation. And we had a couple of months ago, we had a higher than expected inflation rate, and the CPI went over 9%. But the more recent data has come down a bit, and now inflation is only at 8.5%. That's right, that's what they say, only 8.5%, when we all know it is much, much higher. And there's been, a lot of big victory dance in the markets. They're saying inflation's over. We've bet inflation, it's all gone away. Well, people, I don't know if you remember, but also inflation went down at the start of the year as well, only for it to go higher and higher and higher. So just because we've had 1 month a read of low CPI doesn't mean inflation is over. And the Federal Reserve has also come out and reiterated that they're going to keep lifting interest rates regardless of this one, little drop in CPI, and that they're going to want to see inflation come back down below their 3% target, and they want to see it down substantially before they claim a victory. They're going to keep lifting interest rates. And again, even if they stop lifting interest rates, they're not going to drop interest rates back to zero like they did in 2020, because this will create the same problem that happened in the 70s and the 80s when, they rose interest rates up to 10, 15%, then they dropped it and thinking inflation was over. This just made the inflation problem much, much worse. And it's not just lifting interest rates what they need to do. They also need to do something called quantitative tightening. That's where they need to sell assets off their balance sheet. And the last time they tried to do this in 2018, we saw the markets completely break down. We saw the markets drop 20% very, very quickly into a bear market. And they had to reverse course. But remember, people, they had the luxury of inflation was low compared to what it is now. They're not going to have the luxury of being able to quickly U-turn and drop interest rates or start printing money again like they could in 2008 and in 2018. Because many people are saying the bear market is over. They're saying, look, the market's up 16, 17%. The bulls are back in control. There's nothing to fear here. The bear market is over. Well, before we claim that the bear market is over, let's actually have a look at history to see what is actually the historic average bear market rally during the past 40 bear markets. Well, like we said, the S&P 500 has gone up 17.4% over the past 41 trading days, according to a recent Bank of America note. And the average gains for the S&P 500 during the past 43 bear market rallies have been a rise of 17.2% over an average duration of 39 trading days. This recent rally doesn't mean we're out of the woods yet. So please don't get caught up in FOMO and fear of missing out, seeing that, price go up, I got to get in now when the price is going up. Please do your own research and please do some deep thinking if you think now is the best time to come in. What you have to know is this is just the beginning. The Federal Reserve has only just begun to lift interest rates. We haven't got the data yet to see how these high interest rates are going to affect the markets. They've been raising them so rapidly, we haven't got that data yet. And they're not going to stop at 2-3%. It is not going to be enough to stop inflation. They're at least going to have to go to 5% if they're going to be serious with fighting inflation. And while I agree, they're not going to have to go to 10-15% like what Paul Volcker did, because debt is so much higher. Because, for example, paying 15% interest on a mortgage of $100,000 may seem like a lot. Well, if your mortgage is $500,000, $1 million, just paying 5% more interest is going to be a big, big increase. Because look at this chart, everyone. Look in the 70s and 80s, debt to GDP was only around 30 to 40%. Well, what is debt to GDP now? It is 124%. So for every 1% increase in interest rates is going to have much bigger effect than it did in the 70s and the 80s. And not only this, but the Federal Reserve is just only beginning quantitative tightening. And some are even speculating that they're not really selling off the amount of treasuries and mortgage-backed securities that they're meant to. They're meant to sell 47.5 billion worth of government treasuries and mortgage-backed securities. The speculation they're not really selling that much. We'll have to wait to get more data to see what they're really doing. So we know there's a big banking crisis and housing crisis in China. We know the US is in a recession. We know this is a classic bear market rally. And I'm sure what you're also wanting to know is, okay, well, how this affect the housing market in the US as well. Well, like most real estate experts say, for every 1% increase in interest rates, people's borrowing power gets reduced by about 10 to 15%. And we're already starting to see this with home sales absolutely collapsing. Listen to this. Home sales fall nearly 6% in July as the housing market slides into recession. And sales dropped about 20% from a year ago. In terms of economic impact, we're surely in a housing recession because builders are not building, said Lawrence Yuan, chief economist for realtors. So what you have to know is people are saying, look, don't worry, nothing's wrong. Again, this is just only the beginning. And like I tried to warn about how Evergrande will cause a banking and a real estate crisis in China, I said it's going to take time. Look, it took about 9 months for us to start to see how this is going to affect us. And yes, while they're saying, look, house prices aren't dropping now, so there's nothing to worry about. Well, it doesn't mean it's not going to happen. These things take time. And unfortunately, with social media, when you post a video, you put out a warning, people want it to happen the next day, the next week, the next month. Unfortunately, things don't work like this in the financial world. Things happen very, very slowly. But it does not mean you're just going to be blind and ignore what is going to come and not prepare. For example, for the past 2 years, I've been warning people, look, we're going to have a food crisis, food shortages. You want to start storing up on food now. Now, what's happened to food prices? Food prices have exploded, and now people can't afford to prepare to buy all this extra food because they're too expensive. It is too late for many families right now. So I'm sure you're wanting to know is, okay, what does all this mean in simple terms? What this means, people, we have many, many crises going on around the world right now, all at once. They're all colliding, which is going to make one mega crisis, one global financial crisis. We're seeing countries fail like Sri Lanka. We're seeing big issues in Pakistan. We're seeing currencies collapse like Argentina, like the Turkish lira. Many, many fiat currencies around the world are failing. And with the US dollar strengthening, this is going to create a foreign debt crisis, because people have to use more and more of their currency to repay the dollar. And what this means, we're going to be facing a global depression, not just one country's, here or there in a recession and some, getting out of it. Everything is interconnected, and we are going to face a global depression. And, there is going to be a lot of unrest going around the world. And I hope there's not going to be more and more global conflicts, but that is something that may be a real possibility, and the markets are simply going to fall. I don't think this is a good time to get in now. This is my opinion. I won't always be right. This is just from me, from studying what has been happening over the past 2 months. Even though the markets have been going up, remember, the markets can remain irrational longer than you can remain solvent. I do not think this rally is going to last. I think this is just to get people to sucker in, to buy this rally, and then there's going to be the big investors coming to dump on retail investors. Now, to all my loyal viewers and subscribers, I do apologize for not uploading over the past few months. As I'm sure some of you know, I've said in previous videos, I have been in a bit of a dark place mentally. I have not really been motivated to put out content because I wanted to wait for these crises, what I've been warning about, to actually come to pass. Because unfortunately, I try to put out these warnings ahead of time, and people, make fun of me. They call me a fool because they don't happen. So I said, okay, enough's enough. So I'm not going to keep copying this flack of saying there's no recession coming. China's not going to enter, real estate crisis. There's no banking crisis coming. I said, okay, I'm just going to step away. I don't have to do these videos. I do these videos because I love doing, because I'm passionate about doing them. I try to help people. I said, okay, I'll sit back and I'll wait until they actually come. I'll wait until these things I tried to warn about people will actually happen. And then I'll come back and tell people, look, you know what? I did try to warn some of these people about, but this is what's really happening. And this is what we should do going forward from here. Now, unfortunately, there's been so much happening over the past 2 months. I could not possibly cover it all in this video, but don't worry, I am going to get back to more frequent uploading content, and I'm going to go more in depth into each of these crises that are happening individually, one by one. I'll do individual videos. Again, I can't cover them all here in this video, or it'll be hours long. But thank you for watching, and of course, I'll see you all in the next video.